Looking at the three services in more detail, asset management is what I was talking about in terms of fund management, where Avrio and Foragen are examples. Transition management is the interim management, sometimes workouts or bringing in, supplementing the team as you're working through different issues. And transaction management is primarily selling the company through M&As, mergers and acquisitions, or also helping manage partnerships through what we call IP transactions. How does this fit in the whole value chain or the whole life cycle of a company? From the startup stage, we can get involved in terms of the development of the strategic plans. In terms of the growth stage, helping them build market traction through partnerships, through other market penetration strategies, helping through organizational structuring in terms of ensuring there's the right infrastructure in place to build the companies, ensuring the right management's in place, into the moving the companies towards exits. And one of the areas I want to focus a lot today is what I call IP transactions or partnerships. What we have learned through our fund is one of the best ways to finance companies is actually through partnerships. It's a lot cheaper money, it gives you access to marketplaces, and it really validates the technology in terms of the eyes of the potential investors. So moving on from this experience, how do we approach financing in agroforestry? Well, first of all, venture financing in agroforestry is a challenge. I would say Alberta's probably in a better position. Maybe some people disagree, but from my experience across North America, Alberta's in a better position than most regions because Alberta has a lot of good infrastructure programs that are in place that really do support these companies. But overall, venture financing is at a historical low. 2009 was the lowest year in record in the last 13 years for venture-backed transactions. The number I saw, if I recall correctly, was a reduction of 85% from the peak in the late 90s. So a significant reduction in available capital is available from a venture financing perspective. Moving into earlier stage, the group of funds that have been hit the hardest is seed funds. So there's even less seed funding available. And there are very few VCs that specialize in this sector. So there really have been about 5 or 6 venture funds that have been financed in the last 5 years. And most of them will identify either IT and clean tech as their primary areas of investment focus. Most VCs will invest in a very small percentage of the deals they see. We at Foragen saw over 600 deals and we only picked up 10 companies. So even if you have a good story, the odds of getting traction with somebody are still fairly small. That said, it's not all gloom and doom. There's still deals being done. You have to be creative. And what we do is we typically target 3 types of financing. Venture funds, corporate partners, and I'll focus more on the middle one, and also non-dilutive funding, which is quite often they're not looking to take a percentage ownership of the company, and they may look at some creative and sometimes very either grants or some reasonable payback structure that is actually quite supportive of the companies. One thing you should not do also is ignore angels, and we have done that fairly successfully. So looking at venture funds focusing on the agri-sciences, there are a few Canadian funds that do focus on this sector. In Alberta, they'd be predominantly AVAC and Avrio. There are also a number of other corporate funds. None of them are Canadian-based, but there's Syngenta, DSM, Tate & Lyle, are just to name a few. Danisco had one, which I think now is just Stop Investing. Life Science Partners is another one that was active, that's also Syngenta-based. So there's a number of funds in this area. There's a number of agri-science opportunities that will qualify as clean tech. So what we are seeing is actually a lot of clean tech funds have raised a lot of money, and now they're looking for good deals. And they're trying to move outside of their sweet spot because they're not finding the quality of deals that they want. And when I sit back and listen to all the stories today, I would say over half, probably 3/4, can be positioned as clean tech stories. Syngas, biomass conversion. So there are funds out there, but when you approach them, you have to pitch them on a clean tech story. It's a different approach to them. And when you prepare, you have to prepare the companies for financing. You need to understand what will make the companies investable. In other words, their primary objective is a return on capital. If they're putting in $3 million and they're going to be in for 5 years, they need to see a reasonable way to walk away with $15 million. So that means you need to have the ability to build a fairly substantial company. You need to build a relationship with each fund. What we typically do is a year or two before, we will have our companies start with their pitches, working with potential, identify a handful, 5 to 10 funds that they think are the top leads, and just start working with them and testing their story and getting feedback from them. But the most important thing that we want is to make sure the company has enough momentum that it keeps hitting good milestone after good milestone or getting good progress so that the investors build confidence in the company's ability to execute. You need to get early successes that validate the business plan. And what we mean by early successes is finding a way to confirm that somebody in the marketplace is willing to write a check to buy your product at a price that you'll make money and enough of it that will justify that you can make a really good business out of it. And you need to stretch the runway while achieving these successes. So if you talk to a lot of people in the venture capital business today, they would say in the mid-90s and 2000 range, we invested in companies too early. So programs like ACAMP and those are great programs of finding ways to stretch the dollars and getting to a much later stage proof of concept with the technologies and getting to a stage where you have a stronger story to attract investors. There are also a number of other sources of non-dilutive financing. AVAC is one. I quoted it as non-dilutive ROS because you don't invest in equity. Agri Opportunities is one that just recently, I think, closed their fund, but there's some consideration that they may extend its Ag Canada program. And I'm just mentioning a few here. There's a lot more programs. IRAP, NSERC, Sustainable Development Technology Canada, SR&ED tax credits. We've actually had, in some cases, challenges with our companies because they're leveraging too much non-dilutive money that they're hitting the caps of a certain percentage of government money. So this is a really important source. One thing you have to understand, though, is that each source of funding has different criteria. So if you're going to maximize, some will fund market development, some will fund product development, some will fund capital infrastructure. So you need to know how to leverage those and position them to get the most money out of them. The one area I want to focus the most on today is corporate partnerships. And this is one area where you can really position a company for success. We've had a company that was having trouble raising money, and it was one of the 4 that we mentioned there, and its bank account there was very few zeros in its bank account, so they didn't have enough money to go very far. And what they did is they focused on closing a corporate partnership, which generated enough cash to carry the company a year and a half, close a second partnership. The terms of the follow-on financing resulted in a significant gain in our portfolio. So the point is, if you can get the right partnerships that validate your company, then you can really position your companies for growth. Now, partnerships provide many benefits, but sometimes you only give a right to a technology for a certain application, whether it's by geography, by a certain specific application, leveraging, and it limits the options, or they'll validate that application. So let's say if you have a bioinsecticide, somebody may say you have a whole gamut, you have 10 products, they may license the right for 1 product. That's a significant validation of your pipeline and its ability to produce technologies that have commercial appeal to clients. It provides a path to marketplace. One of our companies signed a partnership where the minimum sales threshold was 3 times higher than what the company was projecting by itself at a higher gross margin. And what we found is this company for a while tried to build its own marketing infrastructure, which is extremely expensive when you try to go global. These companies have significant marketing and distribution infrastructure that you can leverage at a much higher and they can penetrate the market much more quickly.